Hello, all. All right. I see you, Brian. Okay, I think we're good to get started here. Just got one account in. Just invited you up, Brian, if you'd like to join. I see JC. Perfect. What's up, Brian?
You guys are interrupting my nap time, but I'm okay.
BC Lund in the house.
BC and JC. I love it.
Dude, this is great. And Fahmy's coming through too, supposedly. Fahmy's like so MIA. He never hangs out.
Fahmy's coming.
Fahmy's either at a concert or in Vegas or in Boston. Fahmy don't hang out anymore. In the old days, Fahmy was always around.
I love it. I love it. JC, good to chat with you for the first time. How's everything going?
Everything is, man, never been better. I appreciate the invite so much. And I didn't even, I said yes just because BC was going to be in the house. I was like, that's good enough for me. And then I just found out a little while ago that Jay Woods is in the house, Joe Fahmy in the house. So, like, talk about bringing the band back together.
What a house. It's a great house. I love this house.
Only stacked panels.
This is like MTV Road Rules, like Twitter Spaces edition or some shit, you know?
JC, is it true you're down the Jersey Shore right now?
I am down in beautiful Avalon. Man, I like it here.
Where are you going out tonight?
I am not going out tonight. I have a 1-year-old and a pregnant wife. So,
congratulations on that part. I did not know that part.
Oh, yeah.
That's fantastic.
Jay, I got twins on the way, bro.
All right, we'll talk off air. That's fantastic, man. Congrats.
Thank you. I appreciate that. And man, going out for me is like a 5:00 dinner. Like that's the extent of my outings these days.
Well, that's how I feel about this space. It's starting at 6:00. I'm in my car. I just hit the bank. I got things to do. This is like the weirdest time. But Gav, I'll be here for you guys. But forgive the background noise. I'm in the car. I'm running some errands. Where's Fahmy? I see we got Brian here. I don't see Joe.
I have the commitment from him in writing.
Fahmy's either at a concert, planning on going to a concert, in Vegas, planning on going to Vegas. Fahmy, there's like a handful of places. He could be at an all-you-can-eat buffet. He's been known to do that sort of thing.
I love it. Okay, so I'm just want to roll us into the time here. I don't want to keep anyone too long. And yeah, I know the time is interesting, Jay. I don't know. I wanted to, I host these spaces sometimes until like 9:30 at night. And I figured maybe once in a while I can get off early enough to, eat dinner with people, things like that, do some natural society things. So we're trying to move them up a little bit.
Good. I'm just having fun with you.
Yeah. I'm messing around. Okay, I just put out a tweet and I tagged all of the speakers in it. If anybody could go ahead and interact with that, it's pinned up top. Or if you could share out the space on your own, it's just that little blue button on the bottom right of the space. That'd be super helpful. That's how we're going to get your audiences in here. I know they would love to hear from you, especially the ones that are more rare on Twitter Spaces. So if you're able to share it out or interact in some way so that we can get your audiences in here, that would be fantastic. With that being said, let's go ahead and launch right into it. So we did a space last Tuesday, I believe, or maybe it was 2 Tuesdays ago at this point. We had on Jay, we had on Brian, and we had on Ian McMillan. And we were chatting a little bit about, what's going on with the market right now. We had just bounced off the anchored VWAP at 384 on SPY. We were starting to come up. And the consensus was, cautious optimism. We might move a little bit higher here. However, coming from Ian and a couple others, the ideology was, this is going to get blown away. This maybe we'll have a short-term rally, but it's not going to last very long. We're going to come back down. And it's pretty interesting. So we're kind of came up on that short-term rally, and then we've just moved sideways for about a week straight. So there hasn't really been too much to go off of. So as we're forming this consolidating pattern, and hard to tell whether, bullish or bearish at the moment, I was, wanted to run back this panel and kind of have a discussion as to where do we stand with the stock market? How are we feeling on SPY and the Qs? What do we like, in the market right now, certain areas? What do we not like? And that's the overall gist of it. So Brian, you were super helpful in getting some speakers on this. So I'm going to go to you first, and we'd love to get your initial thoughts, and then we'll just bounce off it from there. Oh, and real quick before Brian goes, to JC and Evan and Jay, on a lot of my panels, they're very structured and everybody's called on before they go and stuff. But for these, I just love to have the free flow. So if Brian says anything that you want to come in on, just feel free to unmute and just speak after him. And, if you want to raise your hand, there's the little raise hand feature. It's by the heart emote. So you can use that too. But we'll just have free flowing conversation. I always like that best. All you, Brian.
Yeah, so we were saying on the call, I guess it was 2 weeks ago, that we were looking for maybe a counter trend rally in an overall downtrend, something that would maybe last, week or two. And I was saying that I always judge a rally by what happens after it pauses. So, you get a rally that goes up, you get that first pullback day, then what happens? Do we base for a while? Do we hold up in the top 25% of that move or the top 33% of the move, base sideways, and then, go higher? What do we do after that? And all we've done is literally go sideways. Like if anyone is new to charting and they want to know what a base is, that's exactly what we've got in the SPX right now. And not only that, but we have this base that is trapped between opposing forces. Below it, we've got support. Above it, we've got resistance. It's getting squeezed between a 21 and an 8 and on the downside and the 50 on the top side. So you usually see contraction before expansion, and that's what we've got right now. It's going to break hard one way or the other. I don't know which way it's going to go, obviously. I'm leaning towards up, but it's still definitely going to be a counter trend rally, even if we do break out from here.
Can you elaborate a little as to why you're leaning up before Evan goes?
Yeah, so what I've noticed in the last 2 weeks is the market has reacted different to negative news. It first jumped out at me when we saw earnings after hours in Snow and NVIDIA. Prior to that, whenever there were bad earnings, the stocks would just tank and then they would roll over the next day. Both those stocks initially tanked, then they recovered, then the next day they ended up green. And that started the first hints that maybe the market was getting used to the bad news, was factoring it in. And then we've seen that this week. Like, for example, today, Target came out with really bad news, which prior to 2 weeks ago, I think that would have rolled the market over. But not only did it not roll the market over, we rallied off of that. So, maybe the market is starting to factor in some of that, and that could be the first sign that we're seeing a little change in the tone and tenor of the market, at least in the short term.
Yeah, first, I just want to say thanks for having me on here. And JC, what's up? I heard you at the beginning of this saying, BC Lund is here, I'm in. And so here's my hack for everybody. If you just want to level up, you want to improve your financial status, you say yes to anything BC Lund is in. That's what I've learned. So that's my first comment there. Just some love to everybody on this panel, really. In terms of markets here, so I totally agree with everything that Brian laid out here. We've got objectively sort of this counter trend rally, right? If we look back over the 6 months, markets are making lower lows, lower highs, 50 SMAs declining, 200 SMAs declining. So we've got this objective sort of downtrend over the past, handful of months, and we are rebounding now up off of the lows. Now, here's a couple of things that I actually really like. I think the last 7 days is just like a total gift. I love this sideways action here, just repeated overlapping bars, banging around in this 2% up and down range. Like, it's beautiful because as traders, we love levels to trade against. We love clear sort of lines in the sand, or at least I personally do. So I know how to trade, where I can trade against, where I can place stops, where I know I'm wrong. And so this 7 day sideways with a VIX between 25 and 30. I mean, this is just like this beautiful setup where I think you can play for that range expansion that Brian was just talking about. Similar to Brian, so maybe this is getting consensus. I actually am looking at this as a potential resolve up. This is just, total kind of pie in the sky, putting my finger up, thinking about which way this will go. I'm willing to be wrong. I'm willing to adjust, but I'm looking for a resolve up as well out of this consolidation. I think sentiment got really negative over the past 3 months. I think it's cool to hate on this market. I think we all know why this is a horrible market, and it probably is over the next several months. But I think in the short term, nothing goes straight down, nothing goes straight up, and wouldn't be surprised to see a second leg higher out of this consolidation.
Love it. JC, Jay, either one of you want to hop off that?
I mean, listen, I'm happy to jump on this one. I am incredibly fortunate to be able to have regular conversations with a lot of different kinds of investors, from portfolio managers who manage tens of billions of dollars to investors who are just starting out. Over the years, you start collecting contrarian indicators where every time this particular person thinks one way, it's probably best to take the other side. You know, they're like baseball cards, right? You just start collecting them and collecting them and collecting them. And then after 20 years of doing this, you start to get better at weighing the evidence. And the evidence is a combination of price behavior, which a lot of you guys have described beautifully. No disagreements with Evan or BC. You guys are right on point. I agree with all that stuff. I agree with the sentiment. I really think that there's a lot of pessimism out there. I think there's a lot of negativity. And the timing aspect of that bearish sentiment or sentiment in general is very difficult, right? For me, I look at sentiment just to describe the environment, to identify what type of market environment are we in. Are we in a very optimistic environment where people are giddy and it's time for them to get punched in the stomach? Or are we in an environment where people are overly pessimistic? People are leaning too bearish. Recession is too obvious, right? You know, when I hear the perma bears describing why it is that they're so bearish, and they don't tell me anything that everybody doesn't already know, there's a certain element of being priced in. Now, with that being said, sentiment is not a timing mechanism. It's what type of market environment are we in? So, okay, so we are in historically pessimistic, a historically pessimistic environment. Great. Now, what does price need to do in order to indicate that we should be spending our time looking for stocks to buy versus spending our time looking for stocks to sell? That's sort of how I look at it, right? You know, we talk about the S&P and the Dow and all that stuff, and all that is fantastic. But the bottom line is this: should we be spending our time looking for opportunities to buy risk assets, or should we be spending our time looking for opportunities to sell them? And I have been, over the last 2 or 3 weeks, looking for opportunities to buy things. And when I look at something like Chinese internet, which might be the biggest piece of hot garbage on this here planet of Earth, up 50, 60% in the last couple of months, leading to the upside. We're talking about Chinese internet, guys. This is not, value. This is not, high quality here. We're talking about Chinese internet leading to the upside in the sentiment environment that we're in. You know, I think for my money, I want to lean more optimistically, and look for opportunities to buy, particularly if the S&P 500, if you want to bring it all the way back full circle to an index, if the S&P 500 continues to close about 4,100, which is key support, and we continue to close above it, I think we got to spend our time looking for stocks to buy. And then the one last thing, and I'll pass on the mic. I think, and not to be Mr. Macro guy in a stock market conversation, but I'm going to be that guy. I think it all comes down to the United States dollar. I am betting very aggressively that investors are not going to be profitable this summer being long stocks, cryptocurrencies, emerging markets. I don't think investors are going to make money from the long side this summer in any of those assets unless the United States dollar is falling. And if there's anything I'm very confident about, it's probably that. So that's what I'm leaning towards. And the dollar's been weak for a couple of weeks. Stocks have done well. And if you want to talk more short term, when did stocks and risk assets stop being under pressure this morning? as soon as the dollar peaked and started coming under pressure. Then you got to bid in stocks. And I don't think that's a coincidence.
Very interesting to tie it all back to the dollar there. Evan, you got a comment on that?
Yeah, I mean, I knew JC would get to the macro before anybody else. So yeah, I love the key off of the dollar there. I think, you could argue that the dollar broke, sort of the year-to-date trend last week or last couple of weeks, right? And now we're kind of waiting to see how that settles out. The other thing to kind of continue the macro conversation just a smidge more is interest rates. And I am very interested and sort of hoping in the sense, if I'm bullish on the stock market, I want to see essentially rates, let's just say 10, US treasuries, well, we're going to just narrow it down, US 10-year treasury yields. I'd love to see those top out or form a double top if we want to put on our TA hats on, or put in a lower high at these levels. I think today, if we're being super micro, was a good start for that, potentially to play itself out. It's super early, but seeing the dollar break down, seeing interest rates peak or just go sideways, I think that paves the way. That can help pave the way for a relief rally in equity markets.
Got it. Appreciate the insight there. All right, Jay, want to work you into this. What's going on in your mind?
Oh yeah, I forgot I was on screen. No, I'm joking. I thought JC hit a couple good things with sentiment. Where did the market seem to bottom out? When we got a lot of people chiming in. Bill Ackman, he didn't have a hell is coming comment, but he had, I forgot what he said, 3 or 4 weeks ago, and that was kind of near the bottom. We had the Jamie Dimon hurricane comment, followed by an Elon Musk comment, saying that they have a bad feeling, and they may be right, but it's interesting how you hear these big names come against, the market and have this really negative outlook. And then yesterday was my favorite of them all, Cardi B, who Fahmy texted me, said he's running late because he's trying to get her on the call. But Cardi B coming out and talking about the recession. So, we talk about sentiment. You have some major contrarian indicators saying that, maybe it's a little overdone here to the downside. But as far as price action goes, these guys hit it right out of the park. We're in a nice consolidation phase. When we talked 2 weeks ago, we were hoping that 3,800 level in the S&P would hold. It was 3,810. That coincided with a nice Fibonacci retracement from the March 2020 low to the recent November, January highs. And then it was also 19.9% in the S&P on a closing basis. One of my favorite topics, whether or not it was official bear market. Obviously, we're in a bear market, but the history books may say otherwise. And we've been able to chop sideways, and it's been in a nice range, and now we're testing that upper band. And if we go higher in this, what I consider a relief rally, a bear market rally, I was just looking at the S&P 500 can go up another 8% to its 200-day moving average, still be in a longer-term downtrend. It's a hell of a rally, and we cut our losses pretty much in half for the year if we do that. And nothing would change my thesis that, we still have some work to do. I think volatility over the next few months is going to be interesting. We got the Fed meeting next week. We got the CPI on Friday. If we want to go into these things, I'd rather focus on price, but can easily talk about that. Sideways is a direction. I always say that. And right now we got a nice little pattern going, but it feels like the least resistance on this next move could be up a little bit higher here. I know the Russell was at the 50-day today. It's got a little room to run before it hits that old support level, which should act as resistance. And JC hit the KWEB, the Chinese internet names. They made a nice little bottom. They had a breakout above the 50-day, I believe it was. So from a trading point of view, you had a nice risk reward setup, and it's continuing to run. What did you say they were, JC? Like hot garbage, but bottom line is,
the hottest pieces of garbage.
There you go. So this is a sector where if you're looking to make a quick trade and ride the momentum is there. There are spots, but we want to focus on one thing. I know JC talked about the dollar. I keep going back to oil. I was talking with somebody yesterday, and I did a little research on the last the recessions I was somewhat around for and alive for, going back to the 70s. Not that I really was, cognizant of them back then, but most, I think, 5 of the last 6 recessions also coincided with high oil prices. The one that really didn't, believe it or not, was the Great Financial Crisis, and that was subprime. But even .com, there was high oil. So this to me is the one place that will hit the consumers the most. And then you throw in food prices. This is where people are going to change their spending habits. This is where you're going to see things change. So will we hit an official recession? I don't know. That's for the economists to decide. And when they decide, guess what? They're going to pinpoint it back to January, and that's probably when you want to buy, when they officially hit recession mode, because we've been in it for 6, 7, 8 months, whenever they determine it is. So that's the other hot topic, as Cardi B mentioned, to go full circle. And I will throw it back to you.
I like how much Cardi B has made her way into this space. Love it. Awesome, Jay. Okay. Stock Talk. Want to throw any thoughts in here?
No, I agree mostly with what JC and Jay just said. I mean, I think you can look at oil, you can look at the dollar, you can even look at commodities broadly, and there have been trends. I think tradable trends you can identify if you're trying to play a bounce. But I mean, I think for the most part, again, and I've sounded like a broken record on this, I know, for the last few months on Spaces at least. I really think that inflation data is the key domino here, because I think a lot of these other pressures fall out of the way if we get a peak in inflation. And if we're looking at the next CPI, PPI, PCE, which the next CPI reports this Friday, and then we have GDP on July 28th, which will be the advanced GDP for Q2. And I think I posted this tweet, when was it, a couple days ago, but just a recap of the last 13 rate hike cycles. So, the furthest back that data goes is 1946. But if you look at the 13 rate hike cycles since 1946, 10 of them have resulted in a recession. So to me, that is the most consistent indicator to use in a vacuum, is just the tightening of monetary policy. And the reason that I think that the peaking in inflation is the domino we need is because if inflation peaks, the Fed's going to take their foot off the gas. I mean, that's the mandate they're reacting to, right? The Fed is not reacting. The Fed has 3 primary mandates, and the one they're reacting to right now is the fact that they need to ensure price stability. And so, knowing that the current rate hike cycle is a reaction to inflationary pressures, also knowing that I think most analysts, and the Fed has spoken on this as well. I mean, last time Powell spoke publicly, he literally specifically mentioned the war in Ukraine. And so I think people are aware that the external catalysts, the war in Ukraine, the potential rolling lockdowns in China, now that situation has been improving. We've seen Chinese stocks perform very well in the last 5 or 6 sessions as a result of that. And we're seeing some of those restrictions ease in Shanghai and Hong Kong. But, the war is still going on, and we don't know, that has an indefinite end. And so I think that food and energy inflation are expected to be stickier than normal. But if we get a cooling in core inflation, then I think that's a testament to the fact that the tightening of monetary policy is having a positive impact. And when you get a drop off in broader inflation, again, food and energy excluded, but even if you get a slight drop off in food and energy inflation on top of that, I mean, that only helps the cause. You're going to see consumer discretionary spending open up a little bit, which is probably going to help contribute to improvements in GDP over the next few quarters. So that's the domino I think that needs to fall. Like, I think calling a bottom for a bear market rally, I think you can do that technically in a vacuum, using charts, using inflow outflow data, using a variety of other data and indicators. You can make an educated judgment for technical bottoms for things like these short-term week or 2-week long rallies. But if you're talking about a real bottom where institutions, long-term investors can start confidently deploying large amounts of capital and accumulating positions, I don't think we're there yet. And I don't think we can say we're there yet until we get a peak in inflation, because again, it's the key domino to me that affects everything else. But I think you can still find special situations in this market to trade very effectively. I mean, it's been 2 days in the week. We already got the BuzzFeed puts on that unlock. We already got the Coles arbitrage trade. Today we got a couple sympathy trades off the AERC run. I mean, there are special situations you can find. The uranium plays today, which also worked, which was weird timing because I was tweeting about those plays yesterday. But we got the news today that the U.S. is looking to boost domestic uranium supply. That all of those stocks surged today. There are definitely catalyst-based trades, sector-based trades, and volume-based trades that you can take in this market that will work in any market. So that's what I'm focusing on now. But from a long-term perspective, I think we have to look to the macroeconomic data. I think there's a lot of, and again, I'm not shooting down at all what JC or Jay said. I agree with both of them that the dollar and even oil can be used as indicators to long or short stocks in this market. But from a long-term perspective, if we're talking about, really deploying capital, really accumulating positions, I don't know if we're there yet. And to be honest, even if I miss a bottom as a result of waiting for macroeconomic conditions to improve to where it feels palatable enough to me to say, all right, inflation has visibly peaked. If we get a peak in CPI, PPI, PCE, all in the same month, let's say, and I'm not saying that's going to happen this month, but if you get a visible, convincing peak in broader inflation, again, core inflation, because I do expect food and energy to be stickier. But once you get that point, then I'll personally feel confident deploying, more capital. And again, I might be 5-10% off the bottom at that point, but I'd rather be 5-10% off the bottom than trying to catch a falling knife, because I think we can mean revert SPY back to 380 a lot more easily than people think if inflation, broad inflation, not just food and energy, is stickier than people expect. If this CPI comes in as a disappointment, the Fed themselves, the one thing that's different that I mentioned also when I was talking about previous rate hike cycles, one thing that's different about this rate hike cycle is the Fed does not really know when this mandate is going to improve. Many members of the Fed have repeatedly said, we don't know exactly when inflation is going to calm down. We also don't know if it's going to get worse. So, I know CPI is just a headline number. I know the Fed is more focused on PCE. But taking all those data points as an aggregate, we need to start seeing some improvement, I think, for big money to confidently redeploy on the long side. And again, I don't think we're there yet. I think we need a few more prints.
Okay, perfect. Thank you, Stock Talk. All right, JC, your favorite's made his way to the stage.
Fahmy, thank you for joining us. I know with your busy schedule, I can't believe you made it.
Sorry, I was running late. What did I miss so far? Did you talk about how the Dolphins are going to win the Super Bowl? Is that what I've missed so far?
Well, the Spaces is over. You missed the whole damn thing. So now.
I'm sure you guys carried me, no problem. I'm sure.
Easily, obviously. Fahmy, tell the kids how it's done, Fahms.
What are we talking about?
We talked about Cardi B a little bit.
Best 80s rock band. What's the best rock band of the 80s?
We were talking about how back in my day, it used to be Madonna that predicted the recessions. Now it's Cardi B. So.
That's good stuff. What have you guys been saying so far? Sorry I'm running late, by the way. I apologize. Give me a quick to just Madonna, Cardi B, and the Dolphins. Did Jay talk about the Eagles winning the Super Bowl? Is that?
No. That's a given. So don't worry about it. No, what we talked about was the current situation we're in right now. We still believe that we're going to rally a little bit from these levels. Not sold that it's a fait accompli, that the worst is over, but it seems right now the price action has been pretty favorable to another leg to the upside. I mentioned 200-day moving average is one of my levels. If we are to break this recent trending pattern, JC talked about the strength of the dollar. And Brian summarized everything beautifully, as Brian always does. It makes it tough for us to speak. So now it's your turn to just come up with something fun and new. We talked about your Vegas. Are you in Vegas right now?
No, I'm not. No.
No. All right. Where, Atlantic City, perhaps?
Boo. Fahmy doesn't go to Atlantic City. You kidding me?
No, who goes to Atlantic City? No one goes to Atlantic City.
Only when I play Monopoly do I visit Atlantic City.
There you go.
That's
Or good
about it.
cheesesteaks at the White House. That's not a bad place either. But hit us with some knowledge, my friend.
I would agree with with what you guys said. I personally think, and I've been saying this for a while, since April, that we're not going to see a sustained uptrend until the Fed is done. That doesn't mean you can't have counter rallies, but I'm talking about the word sustained for people who know their, just who know their time frame, meaning, a few weeks, few months, few quarters holding stocks. I just don't see anything sustained until the Fed either signals that they're stopping raising rates, or at least they signal that they're going to pause. I think that whole expression, "Don't fight the Fed," is very powerful. And I think they need to tackle inflation right now. I think the good thing this week is it's a quiet period, so there's no Fed speakers, thank God. Like, I feel like they talk every single day, so there's nothing until the Fed meeting next Tuesday, Wednesday. Wednesday we'll get a little bit clearer of a picture, but I just don't see them pivoting because a bunch of people are whining that the stock market's down. I mean, no offense, and I don't mean that as disrespect. I think their goal is to tackle inflation, and they've made it clear they don't care if the stock market's collateral damage. So, and the reason I say that is when you look back at the past at certain lows, and those sort of people follow the O'Neill follow-through day concept, meaning that signs of the institutions coming back in. They've usually been, a lot of the pivots in the markets have been when the Fed gives the all clear signal. They're raising rates in the fall of 18. Then Powell comes out January 4th of 19, says we're going to quote unquote be patient in raising rates, causes a follow through day and the market rallies. When the Fed threw all the bazookas that they threw at during the pandemic in late March, early April of 2020, that caused the low in the markets. When we had a correction in the summer of 2010, and Bernanke came out September 1st of 2010, the summer we had that flash crash, he came out at Jackson Hole and said, we're going to start QE2. That started a follow through day and a new rally in the fall of 2010. So my point is, there's so many historical examples of the Fed pivoting or providing accommodation for the market that led to a keyword sustained uptrend. So I don't see anything different this time. Can you see counter trend rallies? Can you see a rally to the 50-day, or, as you said, Jay, maybe to the 200-day? It's possible, but I'm saying for anything like that, I did hop on towards the end when Stock Talk was talking about, to put significant money to work. I think you're going to need to see the Fed, give the all clear. Now, one positive I'll say is that we gapped up. A couple of weeks ago, we've held the 21-day, which is a key level on the S&P. We held it even today on the gap down. So that's a good sign. But if you noticed, I like to pay attention to volume to see that the institutions are coming back in. We just haven't seen any significant volume showing footprints of the institutions who control the markets coming back in. So I don't know if that helps, but that's my 2 cents for now, or maybe 4 cents for now.
So Joseph, I want to get your thoughts on something. So I brought up, I don't know how early you joined in when I was speaking, or if you heard this, but so out of the last 10 rate hike cycles, out of the last 13, 10 have led to recession. We had soft landings in the 63 cycle, the 94 cycle, and the 2015 cycle. Do you think we print a recession on the advanced print on the 28th? That'd be my first part of the question. Second part of the question is, the average of the months from the first Fed rate hike to the start of the recession, if you're talking about all those 13 cycles, the average is 25 months. So if we do print a recession in the advanced print in July, that would make it the fastest transition from a Fed rate hike cycle to a recession ever. So that would be my question. Do you think it's going to happen?
That's a great point. The first part, I don't know. I mean, I don't want to say it doesn't matter. I think the economy's pretty strong. So even if it is a negative print, I still think the economy's fairly strong, but it's going to get to the point, if inflation does stay up there, what else does everyone spend money on besides food and energy and Apple products? That's what people spend money on. So if inflation stays up there, that's going to be a challenge. But to your point, I didn't think about it, how like things speed up. Things just speed up in general. I just think technology and the way information is disseminated has really sped up cycles. I mean, if you think about March, April of 2020, wasn't that like the fastest bear market ever? Where we dropped 32% or whatever it was, so, and the Fed was quick to act. So I've talked about this on other spaces, how sentiment surveys move faster than we expect. It used to take 2-3 months or longer for, huge shifts in bullish to bearish and vice versa. It's happening in 2 or 3 weeks now. And my only explanation, I don't think there's a right or wrong answer, is that information gets disseminated quicker. So to your point, maybe just things are happening faster and the cycles are happening faster. That could be an explanation, but I don't know.
I think also part of it is the fact that, we started hiking rates before we started QT, which is also atypical, right? But just for the point, just to, about what I was talking about earlier. So from, the first hike this year was in March. So if we print a recession in July, that will be 5 months, which is by far the fastest. I mean, the fastest we've ever gone to a recession from a rate hike cycle was in 1980. And that was by far the fastest. That was 10 months. We started hiking in September 26, 1980, and the recession started in July 1981. So this would be, literally twice as fast as that. It'd be within 5 months. So it'd be interesting to see if it happens. I think a lot of people are expecting it, but I agree with you. I think there's parts of the economy that are strong. I have one more question for you that I'm curious to hear your thoughts on, because it's been a while since I've talked to you on Spaces. But, and this is just my opinion, and again, I could be wrong. I personally think that food and energy are going to be stickier because of the war primarily. And also because I think the war has also spurred this kind of geopolitical trend we've seen all over the headlines the last 3 months of commodity hoarding, especially like rare metals and some of these quote unquote strategically important commodities, which I think is also going to exacerbate long-term prices as well. But, if food and, let's just say, oil stays sticky, let's say we have 100 plus oil all the way through 2023, let's just say, hypothetically speaking, and we don't see demand destruction for whatever reason, whether it's because of a massive choking of supply chains to where, we just have a repricing over the medium to long term, or whatever the case may be. Hypothetically speaking, if energy stays sticky, we have oil, I don't know, anywhere from 95 to 130 all the way through 2023, and food inflation stays sticky. Do you think the economy can turn around, get robust, and grow if we get adjustments to the pricing of food and energy, but we get a broad drop-off in inflation in almost every other category?
That's a great question. I'm like thinking through 2023. I haven't even planned what I'm going to do.
You don't even have to do it through 2023.
I don't even know what I'm going to do for dinner tonight. So it's tough for me to have the foresight through, another 18 months. But
I already had dinner. I'm trying to figure out what I'm doing for second dinner, Fahmy. So any ideas?
JC's the only guy I know has 2 dinners. I love it. I shouldn't say that. Sometimes I do. But through 2023, I think. I think there's a difference between talking about, if that's going to affect the economy or if that's going to, weigh in on the stock market. Like, just because maybe inflation slows down and the Fed pauses, it doesn't mean we go to new highs. It just means the selling can slow down and maybe we can have some sort of stability to the market. But that's a great question you pose. Like, if it does last where oil stays at that level for another 18 months, yeah, for sure, that's going to weigh on the consumer. So it doesn't mean the stock market has to go lower. It just means that the economies, and we might be in a range. We might just be, where some people have said to expect like low single digit returns in the stock market over the next few years. That could be a possibility too.
The reason I ask you is because I'm personally genuinely torn. Like, I do think food inflation is going to be stickier than we think it's going to be. I think inflation is going to be stickier than I think most people think it's going to be, in my opinion. But it's weird because I really do see the trend for most other commodities being down over that period of time. And so I guess the question that kind of arises in my head is, can the stock market overcome sticky food and energy inflation if we see a drop off in the other commodities to such an extent that you see companies in all those other sectors posting big earnings growth, not reporting supply chain issues every quarter like they are now, not doing hiring freezes. You see healthy growth and healthy activity in almost every other sector of the economy, but you have this kind of hurdle, which I think is reinforced by all the geopolitical issues we're having in food and energy prices. I'm curious to see, if I'm right about that trend in inflation. I'm curious to see how it affects the market, because theoretically, I would say most of the market could come back despite that, especially tech. Like, tech's not going to, I think tech can rally in sync with oil in a long-term perspective. I don't think, maybe in the immediate term, those things are trading off trend from each other, but in the long term, I don't see any reason why money can't come back into tech and other parts of the market despite sticky inflation in those categories.
Yeah, and you bring up, I forgot to mention earlier, you bring up a great point that the war throws a huge curveball at this, because in other recessions, we always haven't had that, especially countries that do affect, commodity prices and so forth. So that's a great point. But yeah, you could have other sectors rebound like tech, but maybe consumer discretionary or maybe retail gets hurt because people are spending more money on food and energy, where I'd like to think most commodities would move in sync. But yeah, that brings an interesting point if certain stay higher and some stay lower. But yeah, you could definitely have other sectors lead while other ones are being muted. I mean, we have that now where energy is leading and other things are getting hurt. Maybe it flips the other way. So I mean, that's what makes a market, is that I like to try to identify the relative strength leadership in the sectors that are doing better. But yeah, you could see tech lead even with, higher food and energy prices.
I want to pop in here for just a second. I know we have TSDR that came up as well, and want to get, more Brian and Evan in here too. And Jay, if you have any comments, we're going to run for about 20 more minutes. If anyone in the audience hasn't already, I mean, obviously people are enjoying this conversation. There's over 500 people in here live that have accumulated over the last 45 minutes. This is a elite panel. I was really excited when we got this put together. You can hear the back and forth and the chemistry that they have. But, our original planned speakers with JC, Joe, Brian, and Evan, highly complimented by Stock Talk and TSDR being up here. Oh, and Jay, of course. Jay is top tier, does every Wednesday with us with the street, Thursdays with us morning trading. Really, really good stuff. These are the type of people that you need to be following on social media. This is what social media is for, in fact. Between this panel, there's probably like 150 years of experience within the market. I would say something right around there. I'm here to learn from it.
And that's just Brian Lund with 150 years.
Yeah, exactly. So I love it. So definitely make sure you're clicking in, checking out their bios, going ahead and following them, and really, really just, making the most of these opportunities, because these are the people that you do want to be checking out. So with that being said, Stock Talk, I do see I'm dropping you co-host. I see it now that Evan isn't. With that being said, I want to just keep it rolling around here. And also note, for anyone who's, unfamiliar with the Bullish Rippers account, my name is Wolf. You can see my account up here on the right. I'm co-hosting from my other account. Twice a week, I get to do spaces from the Bullish Rippers account that I run with Stock Market News. We have a great time running this account. I do a couple spaces every week. He does a bunch of content. It's a nice symbiotic relationship. And we're almost at 25K on this account. So if you like our content on the Wolf account on Stock Market News, this is where you kind of get best of both worlds. So we do appreciate anybody that is joining up and following. With that being said, TSDR, you came up, so we'd love to throw it to you to see if you have a comment. And then definitely want to work back in some Brian, Evan, and Jay too.
Right at the end of it, Stock Talk said kind of what I was thinking. Stock Talk and Joe, they with energy inflation, kind of like what Target said, where a lot of their margins were eaten up from transportation costs, stemming from energy inflation. And I think essentially the comment that I was going to make is that if energy and food inflation stays sticky, I think probably the best sector, and we start to see the economy at least hold up a little bit. The worst sectors will be retail and consumer discretionary, and possibly one of the better sectors will remain tech and energy. And Stock Talk just hit on that right before it came to me. So, but I think that's interesting to bring up Target's struggles last quarter. Based on the lowered margins from the transportation costs, I think that will potentially, hurt margins going forward, and causing, inflation to stick around a little bit longer than the Fed would like, and then they can, that more so than they can even almost control.
Yeah, absolutely. I mean, it's really interesting to see which sectors are going to be the ones that are moving here. Evan was joking around with me yesterday. He said, yesterday Jim Cramer went long on oil and Nancy Pelosi went long on tech. Is this the day that we've all been waiting for? So, do we see the short-term bounce? I'm really curious, and maybe we want to spend some time on here towards the end. Brian, bringing it back to you for a second. You mentioned you are short-term bullish. Wondering which areas of the market specifically you are looking to for potential pop here, and how you are allocating your capital into the market, to really minimize risk while being able to maximize some of that potential upside.
Yeah, so I think we have to remember that the biggest rallies come in bear markets. So if that's the context, and we're saying that we're ready to rally, to have one of those ripper rallies, with that is the important background context, there's some areas that are just ready to go, and I think we'll participate 100% if the market does rip. That would be obviously tech. All the tech names are primed. The chip names are primed. Even some of the housing stocks are primed to go. But as my friend JC says, we could solve 99% of Twitter TwinFit squabbles if we could all just agree that we have different time frames. So if you're not a short-term or even maybe intermediate-term trader, you still got to go with the long-term trends. The long-term trend is still energy. The long-term trend is still coal stocks. The long-term trend is even some of the defense stocks like Grumman and Lockheed Martin. So it just really depends on A, what the market does in the short term, B, what your time frame is. And I think the last thing is what your mentality is. JC's colleague Steven Straza said today on their earlier call that the most bullish people are those that aren't paying attention to the news. And that's not a slam on bullish people. It's saying tune out the news, tune out all that negativity, and just watch the market, watch the technicals. They will let you know what's happening, what you should take part in. But once again, you just have to know your own time frames, and then you have to know the overall context. Nothing is going to go if the overall market continues to drop.
Got it. Yep, makes sense. Okay, perfect. Evan, what do you think with that area?
Yeah, I mean, I think Brian once again sums it up pretty nicely here. I mean, I think if you're a fan of relative strength, you're looking at this and you want to play this bounce, or you think you can, you think the market's got a second leg ahead of us for the next few weeks. Your relative strength plays are going to be energy. They're going to be industrial, shipping and ports. And then some of the more boring stuff, utilities, staples. So that's that route. That's where your trends are going to look good. Your charts are going to be clean, and you're going to be trading near highs. Where I am sort of looking at this as a more speculative or looking to get a little more juice out of it. Let's call it the more degen side of things. Then we're looking at the really beaten up things, like I guess Kathy Wood's ARC, right, would be like that good poster example. If you are a trader, again, I'm not recommending this. That trend is very much down. But if you are looking to just capitalize on a bear market rally, then the things that have been beaten up the most, you tend to get that band that stretches. There's been capitulation in some of these names that are down 70% or more from highs. And if you can manage risk appropriately, then there's opportunity in sort of a second leg higher. So really, as Brian sort of said, just kind of depends on what fits your personality in that respect. But again, just beware that this is still a very dangerous market environment.
Perfect. Thank you for that, Evan. All right, Jay, from a macro perspective, we talked a little bit about it. We kind of hit on this CPI print that's coming and some other pieces. What else should people be paying attention to, big picture?
Yeah, well, am I mute? Oh, no, I'm on. I didn't know if I hit the button. Sorry about that. I think Friday is going to be a very interesting day. It could come in light and we could rip higher, because that will be taken as a positive that the Fed may be able to take its foot off the gas a little bit. But like Joe said, don't fight the Fed. In hockey, you don't fight Ty Dome. or Dave Brown in stocks. You just don't fight that. It's a long-proven fact. And as long as we're in that rate hike cycle, it's just, there's nothing, you got to be selective. And I was looking at other sectors that are starting to move over the last month. Materials has made a nice move. And I think materials, that's the XLB, has some room to run. Sherwin-Williams looks like, it's under its 200-day, but it could really make a stronger move to the upside here. So I'm looking for opportunity on a short-term basis, but the long term, as Lund said, it's just, it's still, you want to go where the trends are. ExxonMobil made new highs today. Chevron looks fantastic. These are places that I think, over the next 3 months, we still have room to go. And then look at the XOP. I actually internal email, my weekly, but this 169 level where it closed at, we go back to 2014. Just a little back in this. It is very little resistance up to 300, and you could see one of these FOMO trades in energy where people are like, all right, I give up. We got to be in this space. And here it goes. So that's the sector that continues to catch my eye. And as someone had said, and I've been saying for boring is where you want to be. And that would be select industrial, select material stocks, utilities. Oh my God. Utilities have been, they're always the safe haven. You're getting the dividend. You're getting a nice little return. They're not going down. So that's a win. But that's how I'm looking at it. As far as the macro stuff goes, we talk about this on the other call on Wednesdays, where we talk more macro than technical. Watch the press conference. Let's see what Powell says. I mean, we're going 50 basis points, but for how long? It looks like we've already factored in June, July. Lael Brainerd said something about September even being on the table. That was a little scary. But at the same point, maybe we get it to where it has to go. 10-year was very interesting to watch today. As it spiked over 3, the market sold off, but then it sold off at the end of the day. It closed, 2.9%? I don't know exactly where, but to see that come in and the market take off, it was interesting. So I'm still in the camp. We're going to be okay over the intermediate term next few weeks, but we still have a lot of wood to chop before we're out of the woods here, so to speak.
Okay. Yeah, great points. There certainly is a lot going on, and I wouldn't be surprised to see the chop continue throughout this week until we have a more decisive decision on Friday, and then kind of roll into next week with a little bit higher volume. Okay, awesome. All right. Coming up with about 10 minutes left here. Really good conversation again from Jay and Brian and everyone else that's been chiming in here. JC, Joe, anything else on your guys' minds?
I think that investors worry way too much about, politics and the Federal Reserve and the he said and the she said and Powell and what Janet Yellen had for breakfast and how heavy's the suitcase. And, the market, investors don't give the market enough credit. Right? I think investors in general give themselves too much credit. They give, whatever's on the radio or on the television or whatever it is that, wherever boomers watch their stuff these days. I really think, and this goes back, and I always give Joe Fahmy a ton of credit for this. And this is something I've learned more and more over the years with respects to relative strength. And Fahmy, as long as I've known him, I feel like I've known Fahmy forever. Fahmy's always emphasized relative strength. Like, he's my relative strength guy. Always has been. And every year I go into the new year thinking that I respect relative strength, acting like I respect relative strength. And then at the end of every year, I always get asked by like Yahoo or CNN or whoever, like I always get on these lists, like JC, like we're asking, we're polling, FinTwit, like, what did you learn this year? What stood out this year? And my answer at the end of every year is always, it seems to be always the same thing. I came into the year thinking I respected relative strength, but I totally underestimated it. And this year proved again just how important it is to respect relative strength. Forget the Fed, forget what's on TV. It's relative strength. There's wisdom in the market. The market collectively is way smarter than me or you or anybody else on this Twitter Spaces, respectfully. A lot of these are my good buddies. So the market collectively is way smarter. So if there's relative strength in a particular group of stocks or in an individual stock or in an individual country, there's a good reason for that. And I think that that's really where we need to pay attention. I remember early in the year in January, people were like, JC, nobody gives a shit about your little oil and gas stocks. Nobody gives a shit about your oil stocks, JC. Everybody trades tech and growth. Meanwhile, energy was the best performing sector of 2021. Guess what the best performing sector of the first quarter was? It was energy. Guess what the best performing sector of the second quarter has been? It's been energy. There's been relative strength there. And then at the same token, as much as we emphasize the importance of relative strength, I think it's probably equally important to identify the relative weakness. The worst sector in 2021 was communications. It's the worst sector that, communications, discretionary tech. What's been the worst this year? What's the worst in the first quarter, second quarter? Communications, discretionary, tech, right? There's wisdom in relative strength. And the beauty of technical analysis, and the reason why technical analysis works, is because asset prices trend, right? This is not like random. It might seem like random, right? But we know mathematically it is not. Markets trend. That's why technical analysis works, because that's what we're doing. We're looking for freaking trends. So something that's moving higher has a much higher likelihood to continue to move higher on both an absolute and, more importantly, to circle back, on a relative basis. And something underperforming has a much higher likelihood to continue to underperform. So that's, I think, where we really, really need to focus. And you guys talked about like the mean reversion trades and like tech and communications, some of these stuff. It comes down to time horizon. There's a time and a place for everything. Like Brian Lund said, by the way, Brian, I appreciate the shout out. I'm not the one who made that up. I don't know who it was, but somebody once said that 99% of the arguments on Twitter would not be arguments if we just acknowledge the fact that people have different time horizons. Like, that's just the bottom line. So identify your time horizons. If you have a short-term time horizon and you're looking for a trade and you're looking for a mean reversion and you want to be in Chinese internet or discretionary or tech, that's great. If you want to buy leadership and you want to buy structural trends, that's a completely different time horizon. It doesn't make one better or worse than the other. They're just different. We all have different time horizons. We all have different objectives. We all have different risk tolerance. I think it's important to identify that. So if you're looking for trends, a lot of the areas that these guys mentioned, oil and gas, materials, industrials, and then when you look within tech, as shitty as tech has been, look at the relative strength in semiconductors relative to other industry groups within tech versus software versus some of the other areas. And Straz has gotten multiple shout outs, not to get his head any bigger, but Straza has really been, pounding the table how semiconductors are more cyclical in nature versus other quote unquote growth areas, right? There's more cyclicality to those semiconductors. So the fact that we're seeing relative strength in semis says a lot about the state of the market, number one, but just in a vacuum, much stronger than some of the other areas within tech. So I think that's probably a decent place to look if you're looking for structural trends. And if you just want to bottom fish and buy the biggest piece of hot garbage you can find, there's nothing wrong with that. But I think you have to understand that that's what it is. It's not a You're not marrying that company. It's just a trade.
Did somebody
say
hot garbage? Was that my cue to talk?
Tell him, Fahmy. Tell him about relative strength. Brother, I give you the credit. You've been pounding the table on relative strength since the day I met you, and I underestimated. Every year I come into the year underestimating it, and you nailed it. Love you.
What was that? Thank you. What was that, 1904, 1905? You make us out like we're 100 years old. No, thank you for that. I mean, I agree with 2 points. One that the first one that JC said about how great I am, so thank you. No, I'm kidding. The point I really like is what Brian Lund said about the people who are a little more happy, a little more bullish, a little bit more constructive on the world, on the markets, and on life in general are the ones who watch less news. I think that's such a Brian just casually said that. It just resonates with me because a lot of people get on these spaces and it's just a battle of how smart everyone wants to sound. And I watch the news and I'm intellectual with my big macro picture and the 210 spread and a balance sheet and a cyclical rally within a monkey, within pigs in a blanket, within a bear, with it. Like, who gives a shit about all that? None of that matters. Stop overthinking things. The only thing that matters are the institutions. And you know why? Because they control the fucking market. I can't say that enough. The big institutions, not me, not you, not someone with 10 shares, with 100 shares, or even 10,000 shares. It's the big pension funds, mutual funds, and hedge funds that are buying and selling millions and millions of shares. They are the ones that control the markets. So what do? You have to pay attention to what they do. You have to learn how to read tape, simple, price, and volume, which ties into JC's point of relative strength. So when they come back in, when there's an appetite for growth stocks showing risk on, when there's an appetite for small and mid caps showing risk on, that'll be a sign that we're ready for the keyword being a sustained rally for people who like to trade more than 7 seconds. So, and the point about relative strength that JC said, I've said this before in so many spaces, it shows up over and over and over again. What does it mean? It means relative to the market, things that just showed incredible strength. During 08 and 09, the entire world got obliterated. Housing crisis, financial crisis, everything's down 90%. Netflix and Green Mountain Coffee were near new highs in March, April of 2009, went on to 1,000 to 3,000% moves. Coming out of the most recently, the pandemic in March, April of 2020, it was the Zooms and the DocuSigns and a lot of those stocks that were near new highs in April of 2020, went on for 300 to 500% moves. So the same thing will happen again this time. I don't want to say I guarantee it, but it just happens over and over and over. And you just have to be patient until those signs show up. So I think that's what keeps me optimistic, to stress Brian's point, is the less news and a little bit more price action and relative strength. And then you just have to be patient until those show up.
But what's the trade? Like, we're talking about all this macro, philosophy, education, which is great. Don't get me wrong. This is great. It's great for those listening, and it's great for us, me, Fahmy, Brian Lund,
what's
Jay Woods.
What's great?
The trade is short until the trade is net short until there's
net short what? Net short what?
Net short almost everything except for commodities that have tailwinds.
I think for the average retail person, I'm not against shorting. I'm not an advocate of.
Yeah, I don't mean net short. You don't have to short outright.
If you've been net short over the last month, you've gotten smoked.
No, but since February, I've had RK puts as one of my largest positions since February. Those puts were up thousands of percent. So yeah, are
correct.
All,
but
did I sell?
Great, but it's June.
But I'm just saying now. JC's asking about now.
No.
Yeah, February is June.
No, I'm not saying I sold all of them the peak. I'm saying that's been the trade. What's the trade going forward? For me, I trade what's at cycle. So I'm a catalyst-based trader. So for me, this week, I've traded Kohl's as an arbitrage play, right? We knew that deal last week. I talked about it on Play of the Week on Sunday. There was an offer between $55 to $60 for Franchise Group and Sycamore for Kohl's. It was trading at 41 on the close on Friday. That was a trade, right? The uranium trade, I talked about that this weekend. Talked about it this morning. Today we got news on the U.S. deal for domestic uranium. Every one of those stocks ripped. That's a trade. So I'm saying there are trades, but there's special situations. In my opinion, you can trade special situations and catalyst-based trades in any market. That's what I like to do. In terms of a medium to longer term perspective, if you're saying what's the trade over the next few months, I think there's several trades you can make. We just got news tonight about the European Commission is considering banning the production of lithium in Europe. That's going to cause lithium prices to soar. So maybe lithium's a medium-term trade. Like you said about energy relative strength, JC, I don't think it's
Yeah.
necessarily about
By the
relative
way,
strength.
I
think it's
appreciate the
100%.
lithium trade. Lithium's been working, right? You look at
Yeah,
Sociedad Química y Minera de Chile, which is a Chilean lithium.
Yeah, I've been
You look at
long lithium since 2020.
That's
Yeah.
that's
You're talking.
SQM
I don't
for
know
people
what
who
I don't know
understand
about
English.
2020, but the lithium trade's been working. I mean, you want to talk about
No,
relative
it has
strength, right?
It has been working since 2020. Yeah.
JC, Stock Talk legally changed his middle name to Lithium. Like you're talking to the guy who cannot stop talking about lithium. Trust
Good.
me.
I mean, it's been working. Good for
I don't
him.
have an hour.
Good for
I think I
him.
gotta have more tweets on lithium than maybe anyone. I would say probably
For good reason.
I love it. I'll be long lithium for a lot longer than this year. Even if all these stocks go down 20% this year magically, I'll just buy more. I think it's probably the best commodity for the next 10 years.
Dude, you want to know the best part about technical analysis? I don't know what the fuck lithium even is.
I'm going to take some tonight.
Yeah,
I just know it from the Eminem songs. All right, so
That's funny.
We're a little bit past.
Sounded like Mark Minervini there, GC.
Yeah, careful. The funniest stuff ever was when I actually interviewed Mark Minervini, and there were technical difficulties during our interview. Not planned, but literally did happen when I interviewed him. With that being said, this conversation was incredible. I definitely want to run back this panel, so I'm going to be in touch with all you guys. We definitely got to get you all on more often, maybe like a bi-weekly thing or something. Who knows? With that being said, I want to go around and just give everybody a few minutes here for any other comments they want to make, anything they want to touch on. I just have to move into some closing comments because I got a dinner in about 20 minutes. So Brian, would you like to start us off first here?
Yeah. I just want everybody, I'm always assuming when we do these things that there's a lot of newer traders, newer investors on these spaces. And, everyone that's talked was a new investor or new trader at some point. And I just want you to just keep context. I mean, if you're in your 20s, 30s, 40s, you're going to be in the markets for hopefully decades, right? So don't get too myopic about what's happening right now. Don't get into all the headlines and all the clickbait, just this is a really great, this is still a tough market. And when things are tough like this, what I always say to people if they're struggling is fall back on your process. This is a great time to just take a look and see what you've done over the last 6 months, year, what's worked, what hasn't. Try to eliminate the things that haven't worked. Try to emphasize the things that have worked, and just keep perspective. You got plenty of time to figure this out as long as you don't blow up. And then in terms of running this back, this is to JC and Joe. We got to do one of these live out in HB when everyone's out there in September. I think that's
you want to honestly. I have an open invitation to do whatever I want at this conference. You want to do that? I'm down.
100%.
Like I spoke to. So anyway, Brian Lund is talking about Future Proof in Huntington Beach. Our friends over at Ritholtz Wealth Management are putting it on. They're like, JC, you want to host a panel? I'm like, yeah, sure. They're like, okay, get a bunch of people together and host it. I'm like, okay. So BC, I'm in. Let's do it.
My hometown, baby.
Let me know. That sounds fun. We just had Nick Majuli on Spaces a couple weeks ago, so I'm sure we can make that work pretty easy.
Dude, I went to a butchering class in the meatpacking district in Manhattan, and I go to a butchering class that somebody gave me for my birthday or something. And who do I run into? Nick Majuli at the butcher class.
Did he lean in and whisper in your ear, "Just keep buying"?
We were a few deep. We were whispering some other sweet nothings to one another.
That's fair. JC, it was awesome having you on. Any other closing comments you'd like to share?
Brian mentioned that this is a hard market, and Brian, I love you, bro. I do, you know that. But every market is hard, man. It's not that this market is hard. Every single market environment is hard. And if you're a trend follower, then a sideways range-bound market is going to be hard. If you are a If you are a premium seller that does excellent in range-bound markets, you're going to have a hard time in a trending environment. If you're a quote-unquote growth investor, you're going to have a hard time when interest rates are going up. If you're a value investor, you're going to have a hard time when interest rates are going down. The bottom line is there's a time and a place for everything. So I think it all comes back down to, before you do anything at all, before you enter the trade, I think the first thing that an investor needs to do, I mean, you guys are all big boys, you can do what you want. I'm telling you what I do. First, identify what type of market environment are we in? And once you identify that, then decide what types of tools and strategies to implement for that particular environment. And I think a lot of investors, I would argue most investors, I would argue almost all investors, completely skip that part. They're like, well, I remember back in the day, I used to do this and it worked, so I'm going to try that now. It's like, no, that's not how it works. First, identify the environment, and then identify what type of investments you want to do. So, I'm asking, what's the trade? What's the trade? What's the trade? No one's giving me a freaking answer. I like, I like the uranium stuff that you guys mentioned. I'm long CCJ, so I like that against 26. And I also like, sorry, I got a call there. And I also like Ethereum against 1750, 1700. If we're above those 2021 lows in Ethereum, I like that long. I also like adding to Ethereum positions above 2400. I don't know why nobody's talking about crypto, but I think there's opportunity there. And if Ethereum's above 1750, I think it's a good trade.
Love it. Also, I was just taking a look at Future Proof. I realized they are actually, they're doing that on September 11th. That's opening day for the NFL. Can't be, I got to be in New York. So we'll see what's happening. But excited to see how this all goes down. JC, great having you on. We're definitely going to get you back on some more spaces in the near future. All right, Evan, anything else you'd like to share on this one?
No, I mean, I think these guys hit it really well. Just to summarize us, I mean, to tie back to a comment that Joe made earlier, I sort of agree that most traders probably shouldn't be participating on the short side, or it's just a more tricky way to make money is shorting. If you're experienced, if you've put in the reps, then it's fair game. But day trading, these short-term time intervals and shorting markets, if that's not your jam, you got to just raise some cash, be a little more defensive, focus on the relative strength, all of the things that really everybody on the panel has been talking about, utilities, those things that are working, those are things that are going to work in this cycle. So if you're a long only investor, you don't have to trade every day. You got to just kind of sit on your hands. That's what it really means to be a trader. So I think that's kind of all that really is what comes to mind here. So thanks again for having me. This was a lot of fun.
Yeah, fantastic having you on, Evan. I'm pretty sure that the words relative strength are going to be ingrained into my head after this space, and I think I'll be better off for it. It's like when I bring Brian Shannon on spaces, and he, everything from like don't buy stocks in a downtrend. I've got that tattooed on the inside of my eyes now. So yeah, we take away some great messages from these spaces. And one more time, if you're in the audience, make sure that you are following these speakers. You do want to be seeing their content. Hopefully I'll get them back on next week or the following week, but that's a long time and you don't want to be missing them in the meantime. With that being said, let's go over to Mr. Jay Woods.
Hey, I echo that sentiment about not buying stocks in downtrends, even though, if you can time these things right for a swing trader, day trader, you're going to hit some big rallies here. But, overall, people don't have to put money to work all the time. You can sit on your hands, and that's not a bad thing to do. I always like to look at the risk reward setups from a technical perspective. And right now we're in that chop zone, and, these are the times you mumble. You stay with the stocks that are working. You look for some opportunities. We mentioned Straza a lot on this call. He just tweeted out a very nice chart. What was that, Lyondell I saw? There are a lot of great people you follow here. Ian McMillan is someone that we talked to 2 weeks ago who puts out great setups where, you're at that point where you can flip the coin. And if it goes above here, if this, then that. That is how you should be looking at trades. If it breaks here, then I want to ride it to this level and have my out at that level. And too many people are just, they think this is easy, and it was easy. JC, it was easy in January and February of 2021. That was a market like we've never seen before.
Well, it's easy. It's easy for long only community, but what if you're a short seller? It wasn't easy.
No,
what if you were selling? What if you were selling covered calls? It wasn't easy.
Well, so you're investor is usually that long only to the moon kind of trader, and that's, I would say, 90% of the.
Aren't those retail investors the least important and relevant investors in the world? What do they matter?
They're not. They're not.
What do you mean?
Wasn't Fahmy? What do I mean?
Yeah, what does it matter what retail investors are doing? They don't move markets. Did you not listen to what Joe Fahmy was saying?
Yeah, no, I listened to Joe very well, and I've heard Joe make that comment. I'm not arguing that point, but I think the retail people are the ones that look out to people like us, to give a little more sage advice when things get rough. When things are going well, they don't listen to anybody. You look at your portfolio, it's going up, you're the greatest person in the world. But as soon as things go south, they're like asking questions like, oh, I don't understand this. Why is this going down? What do I do? That was always my favorite down on the floor. With someone coming over and showing me charts after they took a position. Hey, look, I just bought 10,000 shares of this. What do you think of the chart? No. And unfortunately, there are too many people that will buy something and then look at the charts once we go negative. And this is the case. And I've said this many times. In a bear market, everyone is a technician. And that's when I get most of the people coming to me. Hey, listen, I'm in this stock. It's going against me. What do I do? And it just drives me crazy. Well, what was your intention? What was your exit plan? So, to say the retail investors, they're not going to move the markets like we saw back in January, February, 2021. Is that a year, 2021? But it's one of those things where I talk to them all the time. I deal with them with work, and it just sometimes gets me when they just didn't have that plan going in. And then you mentioned I'm going to do a self promo here. We had 500 people on this call. If anyone sees a stolen Toyota RAV4 gray driving around Jersey City, New Jersey, please alert your authorities. I had a little incident Thursday where I get back to my parking lot. My car's not there. Where is it? I don't know. The theory is we're going to see it in 4 years somewhere fighting the Taliban with guns coming out of the moonroof. But so since we have this audience, I'll just throw it out there. If anyone sees a nice Jersey plated Toyota RAV4, yeah, just drop me a line. Let me know. So
that's not the sort. That's not the sort of thing that happens in bull markets, Jay.
No, it doesn't, and that tells you, how hot the used car market is and the auto part market is. But yeah, that was a little funny story I thought I'd share with everybody here. But no, this is a great forum. I'd be on with this group anytime. We don't have to talk markets, obviously, but it's kind of what we do. But I like tangents. I like tangents a lot.
And if you think that we've been in a bull market because the S&P 500 isn't down 20%, you need to have your head examined.
Oh, I love messing with you with that one too. Oh, listen to this. So I on CNBC as I'm walking out of the office today, I can't believe Wapner didn't go off on him. I forget who it was. It was Brian Belsky. Goes, well, technically by the textbook we were down 19.8%, and well, hello, 50% of the stocks in the NASDAQ were down over 50%. 20% were down 70%. Yeah, but we didn't hit a bear market. People, we know when we live through a bear market. This is a bear market. I will have fun with the semantics of it. I have fun with Batnick going back to December 2018, because it went to 19.9%. So it technically wasn't a bear market. But yeah, I mean, we all know this is a bear market. We can continually say these rallies are bear market rallies, relief rallies, and until proven otherwise, as Brian Shannon says, we're in a downtrend, and you want to kind of stay away and be very selective when you're picking stocks in these situations.
Love it, Jay. Yeah, alert out there for Jay's car. If anybody finds it,
thank you.
Please do return it. No, Jay, you're right. We don't always have to talk markets. We can do a little game night next week. It'll be good.
All right. Sounds good. Family Feud. That's my game. Let's go.
Only if we can get Peter on.
Oh, well, Peter, I think you can get. That's it's not hard to find Peter. Shotzi's not
Which
listening in right
which
now.
Peter? Which
Peter
Peter?
Tuchman, the Einstein of Wall Street,
Oh
Mr. Tuchman.
yeah.
Yeah, the most photographed
Yeah.
man on the floor. You know Pete. If you don't, I'll introduce you to him anytime.
He's not hard to find.
No, he's not. He really isn't.
I love it. TSDR, anything else you got to say?
I can relate to Jay because I had our Chevy Equinox was stolen about 2 weeks ago. So I can relate. And I like that these kind of things don't happen in bull markets. You're right. I agree. Anyways, but in terms of the market, I'm the guy who Joseph mentioned that takes those 7-second trades, not actually 7 seconds, more half an hour or so. So you guys don't necessarily want to hear me ramble about that stuff. I'll just keep referencing the QQQ levels that I'm essentially waiting for. Until then, I'm pretty bored at my desk, scalping some intraday moves in between those levels based on essentially the trend of the day. But pretty much 303, we kind of tested that level this morning, and that held. I think we got down to 302.49, and then we saw it get bought up pretty quickly right at the open. But I'm looking for a clean break, hopefully a break and retest of that level to the downside to come back and at least test these lows again. I do think that will happen. Maybe we go higher before then. I'm not sure, but I'll be there trading it. And then, about 315, 314.50 to the upside on Qs to break this kind of 7-day sideways action that we've been in. I'll keep repeating that until some of those levels break and maybe we get a little bit of a trend.
Perfect. Thank you, sir. Appreciate you hopping in and sharing tonight. Stock Talk, anything else you'd like to say on this one?
Nope, I've said pretty much everything.
Okay. Appreciate you being on. Hope everything's working out with the bank and everything. We're going to, just a heads up, by the way, the next space that we're going to be having is Stock Talk space. That'll be tomorrow at 11 a.m. EST, right, Stock Talk? You doing that one?
Yep, it'll be at 10 a.m. Central, 11 a.m. EST. And then I think after that space, Gerg is doing an oil and gas space.
Okay, and then okay, perfect. So yeah, tomorrow, 11 a.m. EST. Make sure you're following Stock Talk to see that space, and then there's going to be a Gerg space, and then the Street's doing a space, and then I'm doing a space at 5 p.m. EST tomorrow covering Ukrainian markets. It's hard to explain on here exactly what it's going to look like, but it's going to be very interesting. All right, Joe, wrap us up here. Anything else you'd like to say?
If anyone's looking to buy any secondary Toyota RAV4 parts, they're clean, they're stripped of the serial number. They're not
Well
traceable.
played. Well played.
I'm kidding. Sorry that happened to you, Jay.
How come nobody's stolen my Lamborghini?
You need that for your chat room. You need a Lamborghini, or else you can't run a chat room. You know that.
My orange Lamborghini. No one's stolen it. I can't imagine.
No, I like what TSDR's point about time frame, and JC's made that too. Everyone up here has made the point about time frame. I think it's important to know your own time frame. So, like when I said for people who trade longer than 7 seconds, there's nothing wrong. I know people who, hey, James Simons made fortunes trading short term. So there's nothing wrong with just know your time frame. And my whole point was, if you do trade longer term type of swing time frames, I've said this so many times, just be patient. There'll be plenty of opportunities. You just got to wait for the wind at your back. And right now it's swirling. We're going to have counter trend rallies, but for a consistent rally, you just have to be patient. I've also said this before, on average, midterm election years bottom around August, September. That's just average. That could just give you a potential sort of statistical time frame for when you can maybe get aggressive again. But again, you got to let it appear on the tape, and it will. Just be patient and stay disciplined until then.
Perfect. Thank you, Joe. All right. With that being said, that is everything for tonight. Really, really appreciative to everybody who came up and made this panel so intellectual and special and a lot of great information. One more time, click in and make sure that you're following them. If you like the stuff that you are getting on Twitter Spaces, go ahead and check out this Bullish Rippers account run by myself and Stock Market News. And of course, make sure you're checking out Stock Talk Weekly for our space tomorrow. That's pretty much it right now. Really appreciate everyone. Hope you had a great day in the market. Looking forward to some short-term rallies in the near future. Take care, everybody. Talk to you tomorrow.
Adios.